Welcome to Delphos Insights. This is episode 26, where we examine financing sustainability in 2026. Blended finance structures that will dominate. In today's capital environment, the challenge of financing sustainability is no longer simply identifying funding needs. The real issue is structuring investments that meet institutional risk standards, governance frameworks, and portfolio allocation requirements. While global capital is abundant, converting it into bankable, sustainable investments remains the central challenge.
If we connect this to the bigger picture, sustainable infrastructure and climate finance increasingly depend on capital structures that are entirely compatible with rigorous institutional investment processes and governance discipline.
Exactly. And our objective today is to really analyze this fundamental structural shift. We are speaking directly to you, the institutional investors, chief financial officers, private equity leaders, representatives of sovereign wealth funds, and decision makers within development finance institutions. This analysis is tailored specifically to your operational mandates.
Right, because we are decisively transitioning from a phase of simply identifying the necessity for climate finance into a phase of strict mechanical execution. Financing sustainability in emerging markets and developing economies now demands structures that fit the precise, unyielding requirements of investment committees.
It's no longer about broad theoretical policy frameworks.
Precisely. It is an environment where risk-adjusted returns and capital preservation must systematically align with sustainable development outcomes.
Okay, well, let us unpack this macro gap. To understand the structural solutions, we really must first clearly define the scale of the capital shortfall. The annual sustainable development financing gap has now expanded to approximately $4 trillion. But that is just the baseline metric.
It is. And if we look at the internal components, the scale becomes even more complex. When we isolate climate finance needs specifically in emerging markets and developing economies, the capital requirement is reaching about $2.4 trillion per year by 2030.
And when we look more broadly at the global picture, global sustainability investment needs are approaching $6.9 trillion annually through 2030.
Furthermore, broader global climate finance needs are currently estimated to fall between $5.9 trillion and $12 trillion annually by 2030. I mean, these figures are driven predominantly by fundamental infrastructure requirements and the urgent necessity for climate resilience.
And crucially, these demands are occurring simultaneously with severely constrained public sector resources. Those numbers represent a massive shortfall. But it is vital that we analyze these figures not merely as a research problem, but as an acute allocation problem.
That is the central thesis. To provide context for these massive figures, financial institutions and asset managers currently oversee roughly $286 trillion in assets. The capital undeniably exists within the global financial system.
So the issue is not a drought of capital.
No, it is fundamentally a plumbing problem. The pipes connecting institutional wealth to emerging market infrastructure are currently too narrow and, frankly, too fragile to handle the required flow.
That is an excellent way to frame it. The core mismatch we observe is between this abundant, available capital and the stark lack of investment-ready, sustainable infrastructure pipelines that actually meet strict institutional criteria.
Exactly. For asset managers, the figures we just detailed essentially define the size of a potentially massive new asset class. However, capital will only flow through those pipes if transactions are structured to deliver risk-adjusted returns that align perfectly with fiduciary duties.
Right, because the primary obstacle for institutional investors is converting that macro-level demand into bankable, heavily diligenced capital structures that private investors can underwrite with absolute confidence.
Which brings us to the operational reality.
So what does this all mean for existing financing mechanisms? It indicates that traditional project finance models simply cannot meet institutional investors' credit compatibility requirements.
What is fascinating here is the precise nature of that failure. Using legacy project finance models for modern emerging market infrastructure is akin to trying to run modern software on legacy hardware.
The operating systems just don't match.
Precisely. Traditional project finance relies on macroeconomic assumptions, like stable regulatory environments and highly predictable currency paths that simply do not apply in today's developing economies.
They systematically fail to provide the risk mitigation, the risk visibility, or the regulatory compliance that modern asset managers and institutional investors strictly mandate before deploying capital.
Which is why pipelines stall.
That brings us to the specific risks that must be managed. When evaluating an emerging market infrastructure project, a sovereign wealth fund or a pension fund will not simply absorb unquantified exposure. They require the explicit allocation of specific risks before deploying long-dated capital.
Institutional capital demands explicit mitigation of political risk, currency fluctuation risk, completion risk, and governance risk. Traditional models generally handle straightforward credit risks adequately, but they completely lack the mechanisms to effectively absorb or transfer these complex associated risks.
If an asset manager cannot quantify the likelihood of a sudden currency devaluation wiping out dollar-denominated returns,
The investment committee will instantly reject the proposal. This failure to allocate risk is what prevents private sector projects from meeting institutional capital's rigorous risk assessment standards.
this directly drives the growing non-negotiable role of enterprise risk management, or ERM. Risk reporting and scenario analysis are no longer just best practices. They are absolute prerequisites for institutional capital participation.
We are seeing a profound shift in due diligence. You need robust data analytics, comprehensive transparency, and continuous risk monitoring to protect against associated risks. And this modern requirement extends far beyond traditional financial metrics.
It now heavily includes third-party risks and cyber threats, correct?
Entirely. New sustainable structures must meet precise net present value benchmarks while simultaneously satisfying these exhaustive risk management protocols. An infrastructure asset is now evaluated as much on its cybersecurity posture as its offtake agreements.
Which naturally leads us to the mechanisms that actually solve this complex equation.
Yeah.
Blended finance has emerged as the critical mechanism to bridge this allocation gap.
Yes.
To define it clearly, blended finance is the strategic combination of concessional funds, meaning capital offered at below market rates from development finance institutions and multilateral banks, combined with commercial capital from private investors and asset managers.
It is essential to recognize that blended finance is not merely a development label, it is a highly sophisticated risk structuring toolkit. And at the center of this toolkit is catalytic capital.
Let us examine the mechanics of catalytic capital. How does it actually function within these structures?
Catalytic capital essentially acts as the mechanism that mitigates perceived risk. It structurally alters the risk-return profile of a given transaction. In practice, this means taking on the portions of risk that commercial investors cannot legally or fiduciary bear.
So by absorbing these specific high volatility tranches of risk, catalytic capital enables private sector participation at scale.
Exactly. It transforms projects that would otherwise fall completely outside the strict parameters of an institutional investment committee into fully investable assets.
However, we must also acknowledge the structural limitations present in current blended finance markets. The concept is sound, but despite recent growth, market activity has historically mobilized only limited private capital relative to the overarching trillions of dollars in need.
The primary obstacles slowing this deployment are fragmented risk management processes and a persistent lack of standardized structures. Mainstream investors currently face reporting frameworks that vary wildly between jurisdictions and development finance institutions.
Every deal feels like a completely new invention.
Precisely. Furthermore, the transaction costs associated with structuring one-off, bespoke deals are prohibitively high. You simply cannot achieve a target of trillions of dollars through boutique, individualized financial engineering.
That is the core issue. Institutional investors now demand scalable investment platforms rather than those bespoke transactions. Mainstream investors and enabling organizations require programmatic platforms that offer replicable, predictable risk mitigation.
Standardization is essentially the only way forward to reduce transaction costs, support market development, and make sustainable development projects broadly attractive for private capital.
The demand for standardization is driven purely by the necessity for operational efficiency. When an asset manager is deploying capital across multiple jurisdictions, they require predictable data analytics and standardized scenario analysis to support risk assessment.
They need structures that seamlessly align with their internal priorities and their highly sensitive data handling capabilities. Standardized blended finance structures provide the exact operational predictability that investment committees require.
Here is where the execution becomes particularly interesting. When we look at the scalable blended finance mechanisms currently gaining market momentum, they center on three main tools: guarantee platforms, first loss capital layers, and risk-sharing vehicles.
These are the specific structures designed for operational efficiency that deliver the exact leverage ratios institutional investors can accurately model.
To clarify the mechanics for a moment, let us look at first loss capital layers. A first loss tranche effectively acts as a buffer.
Right. It absorbs the initial financial hit if a project underperforms, thereby protecting the senior commercial lenders. This provides the structural security a pension fund requires to participate in the senior debt.
And we are seeing this validated by current mega-platform data. For example, the World Bank Group clearly recognizes that guarantees remain the most effective tool for enabling commercial capital inflows. Their guarantee platform now targets about $20 billion annually in guarantees by 2030.
That level of scale is transformative. It promotes risk assessment transparency for asset managers and financial institutions, significantly lowering both capital costs and transaction costs.
It is a massive shift.
Additionally, we must examine the International Development Association private sector window. This specific platform has successfully mobilized more than $31 billion in private investment from roughly $5.4 billion in catalytic capital.
That leverage ratio is exactly what we were talking about.
It demonstrates mathematically how first loss capital and philanthropic capital can absorb specified downside exposure, thereby unlocking massive private capital flows into sectors with high identified risks.
Alongside guarantees and first loss capital, we must also examine the critical role of technical assistance in this ecosystem. Technical assistance functions as a vital investment layer, though it is often misunderstood as merely advisory.
It is far more operational than that. Technical assistance is the mechanical process that actively converts early-stage, inherently risky concepts into fully investment-ready assets.
It essentially builds the foundation.
Yes, it provides the funding and expertise to secure bankable offtake agreements, which are contracts ensuring a buyer for the project output, and solidifies the necessary governance structures. Targeted technical support ensures organizations can accurately identify, quantify, and manage specific risks in developing economies long before commercial capital is ever deployed.
To prove the efficacy of these structures, it is highly useful to examine regional use cases across the globe. These examples demonstrate how linking a macro financing gap to a specific localized structuring solution drives sustainable development.
Let us start in Asia.
Yes, in Asia, we observe the macro application of guarantees through the Asian Development Bank's IFCAP model.
The IFCAP model is an excellent demonstration of institutional leverage. This initiative utilizes $2.5 billion in guarantees to unlock $11.25 billion, supporting a total program value of $12.25 billion.
That is a remarkable multiplier effect.
It brings standardized, guarantee-based vehicles to the market that effectively crowd in private sector participation and public sector co-financing. By providing a programmatic umbrella, this model successfully mitigates credit risks and drastically lowers due diligence costs for market-based investors.
While Asia demonstrates the power of guarantees at a macro portfolio level, we see a completely different application in Africa, where the immediate barrier is not just scale, but local currency and offtake risks. For energy firms operating across the continent, such as BBOX, these specific risks have historically paralyzed commercial lending.
That is precisely correct. If a company generates revenue in a local African currency, but its debt is priced in US dollars, any currency depreciation threatens its ability to service that debt.
It is a fundamental mismatch.
By employing guarantee-backed credit enhancement, blended finance structures successfully overcome those local currency barriers. They absorb the specific volatility risk, thereby unlocking long-tenor commercial lending from private investors that would have been mathematically impossible under traditional project finance models.
Moving to Latin America, the structural focus frequently centers on addressing pre-bankability gaps, particularly within emerging capital-intensive sectors like green hydrogen and sustainable agriculture.
In Latin America, the solution relies heavily on the technical assistance layer we discussed earlier. The region systematically pairs technical assistance grants with concessional capital layers
to bridge that early-stage valley of death.
Exactly. This precise combination moves complex green hydrogen projects from highly speculative early development phases into rigorous investment-grade structures. The technical assistance funds the necessary feasibility studies and environmental impact assessments, ensuring the project is fully capable of attracting institutional capital by the time it reaches the market.
Finally, in South Asia, the structural focus has been heavily directed towards standardizing risk reporting to resolve workflow and compliance misalignments. We see this actively demonstrated in regional offshore wind financing studies and the Bog Bank transaction in Mongolia.
The Bog Bank transaction is a prime example of administrative alignment. Institutional investors operate under stringent due diligence thresholds.
the paperwork and compliance alone can kill a deal.
By standardizing the risk reporting and compliance documentation in South Asia to precisely match institutional expectations, these transactions successfully bridge the operational gap between multilateral development bank reporting requirements and commercial investor mandates. It proves that standardizing the paperwork is just as critical as standardizing the financial terms.
This raises an important question regarding alignment across the entire global landscape.
Synthesizing these regional examples highlights the absolute vital importance of aligning the risk appetite of development finance institutions with the rigid return expectations of institutional investors. Across Asia, Africa, Latin America, and South Asia, ensuring robust risk intelligence and standardizing risk management processes is what actually mobilizes private capital.
It creates the necessary bridge.
When catalytic capital absorbs risk intelligently and predictably, institutional capital reliably follows. Proper structuring is the definitive difference between stalled, theoretical project pipelines and scalable, fully funded, sustainable investment.
To summarize our analysis, we can distill the requirements for financing sustainability at scale into 5 distinct structuring imperatives.
Yes, let us lay those out clearly.
First, achieving credit compatibility. You must explicitly allocate political, currency, and completion risks to the specific balance sheets able to carry them before defining any impact objectives.
Second, standardizing platforms. The market must decisively move from bespoke boutique transactions to programmatic guarantees and standardized first loss tranches that systematically reduce the cost and time to close.
Third, using concessional capital strictly as leverage rather than subsidy. Every public dollar deployed should mathematically mobilize multiples of private investment through highly transparent, quantifiable risk sharing.
Fourth, funding preparation as an investment layer. Technical assistance is essential, functioning as the engineering process to convert conceptual pipelines into rigorously credit-ready assets.
And fifth, structuring strictly for institutional processes. Transactions must perfectly mirror asset managers' internal credit, compliance, and reporting frameworks to unlock long-dated capital. The standardization of governance, reporting frameworks, and risk transparency is absolutely mandatory to mobilize sustainable infrastructure investment at scale.
As you look at your own capital allocation discipline, we leave you with this strategic question. What is your institutional readiness to deploy capital at scale in sustainable infrastructure and climate finance across emerging markets? And do your current risk structuring and governance alignments reflect the rigorous discipline required for this asset class?
It is the defining question for the next decade of capital allocation.
Furthermore, consider this final thought regarding the near-term evolution of this asset class. We have discussed data analytics, but the future integration of artificial intelligence and advanced predictive modeling into scenario analysis could soon automate the pricing of complex political and currency risks.
That would fundamentally alter the speed of underwriting.
By applying deep learning to macroeconomic and geospatial data, institutional investors may soon be able to quantify emerging market risk with unprecedented precision and speed. This technological integration has the profound potential to make these blended finance structures as dynamic, liquid, and easily tradable as traditional sovereign debt, fundamentally transforming the speed and scale of global capital deployment.
This has been Delphos Insights. Learn more at delphos.co.